All right, so you know those little FDIC signs you see like plastered all over banks? I
Uh,
mean, most of us probably just walk right past them.
I don't even think twice about it.
Yeah, but did you ever actually like stop and think about what that insurance really means for, for your money? And how is that different from like the protection you have for your investments,
Yeah.
like with SIPC?
Right.
That's actually what we're going to be diving into today.
That's a big one.
We're going to unpack FDIC and SIPC, explain exactly what each one is protecting,
Yeah.
and ultimately why understanding the difference is super important for your financial well-being.
Absolutely. Because these are both safety nets, but they protect you in very different circumstances. And what we really want to do in this deep dive is like delineate clearly
Right.
what's covered and maybe more importantly, what's not covered.
Yes.
Think of it as like reading the instruction manual for protecting your hard-earned cash and investments.
Yeah, for sure. All right, so let's kick things off by talking about FDIC, the Federal Deposit Insurance Corporation, which has been around for quite a while, actually.
Yeah.
Since the Great Depression,
Huh?
1933 to be exact.
Yep. A long time.
An independent arm of the U.S. government. So in the simplest terms, what's the core protection that the FDIC offers you, the individual?
So at its heart, the FDIC insures the money you deposit into accounts at member banks. And the standard coverage is up to $250,000 per depositor per FDIC-insured bank. And this limit applies to each different account ownership category you might have.
Okay, so let's paint a little picture here. Say a bank, hits a rough patch and, I don't know, let's say unexpectedly.
Yeah.
What happens to your insured deposits?
So in that scenario, the FDIC actually steps in to make sure your insured funds are safe and accessible.
Okay.
And they typically resolve this by either transferring your insured deposits to a new account at another healthy FDIC-insured bank,
Right.
or by directly issuing you a check for the insured balance. So either way, you get your money back.
Yeah.
The goal is to get your money back to you as quickly and seamlessly as possible.
Okay, great. So that's good to know. Your cash doesn't just disappear if something happens.
Right.
What if you have, a few different accounts at the same bank? Let's say, a checking account, a savings account, maybe even a certificate of deposit, all under your name. How does that $250,000 limit work then?
That's a great question. So if you hold multiple individual accounts at the same FDIC-insured bank, all those balances are added together when calculating your coverage.
Okay.
So if you had, for example, $100,000 in checking, $100,000 in savings, and $75,000 in a CD at the same bank,
Right.
the total insured amount would be $250,000.
Okay.
The remaining $25,000 would not be covered by FDIC insurance.
Okay, so it's really important to remember it's the total per person per bank,
Yeah.
per ownership category.
You're right.
Now, let's say you decide to, spread your cash around a little bit. Exactly, you diversify. So let's say you have $200,000 at First National Bank and then another $150,000 at Second State Bank, and both of them are FDIC insured. How does the coverage work in that scenario?
That's a great question. And that's where you can actually maximize your FDIC protection.
Okay.
Because the $250,000 limit applies per bank, you would have up to $200,000 insured at First National
Got it.
and a separate $150,000 insured at Second State.
Yeah.
So that strategy of using multiple FDIC-insured banks is a very common way for people with larger cash holdings
Right.
to ensure full coverage.
Okay, that's a good tip.
Yeah.
All right, so we've talked about individual accounts.
Mhm.
Let's talk about joint accounts. A lot of people have joint accounts with their spouse, with a partner.
Sure.
How does the FDIC handle that?
So joint accounts offer expanded coverage. So for an account held jointly by two or more people at an FDIC-insured bank, coverage is up to $250,000 per co-owner.
Okay.
So a joint account with two owners would have up to $500,000 in FDIC insurance at a single bank. Importantly, this is separate from any individual accounts each person might have at the same institution, which would still be insured up to $250,000 individually.
So there are different ways to really maximize the
Yeah.
benefit there.
Yep.
Now, I remember hearing about the Wealthfront Cash account, and I think they were offering something like up to $8 million in FDIC insurance,
Right.
which sounds pretty incredible.
It is.
How is that even possible?
Yeah. So what's ingenious about Wealthfront's approach is the Wealthfront Cash account doesn't keep all of your money at one bank. Instead, they automatically distribute your funds across a network of up to 32 different FDIC-insured banks.
Wow.
And since the $250,000 coverage applies to each bank, they can aggregate that protection to offer significantly higher insurance up to $8 million for a single depositor without you having to open and manage accounts at dozens of different banks yourself.
Right.
Plus, they provide transparency by showing you exactly which banks are holding your funds on your monthly statements.
I see. So they're basically taking advantage of that, per bank rule.
Exactly.
Okay, very interesting. So for the average person out there listening, what kinds of accounts are generally protected by this FDIC safety net?
Yeah. So for most people, FDIC insurance covers the standard types of bank accounts they use every day. Checking accounts, savings accounts, money market deposit accounts, and those time deposit accounts we know as certificates of deposits or CDs.
Got it. And on the flip side, what financial products are definitely not covered by FDIC insurance?
Yeah, that's a great question. It's important to know what's not covered.
Right, where the line is.
Exactly.
Yeah.
So FDIC insurance is specifically for deposits held at banks.
Okay.
It does not extend to investments like stocks, bonds, mutual funds, annuities, life insurance policies, or the contents of your safe deposit box.
Right.
These types of assets fall under different regulatory frameworks or in some cases offer no protection against the failure of the institution holding them.
Right. Okay, so to recap, FDIC equals bank deposits. So let's shift gears a little bit. Let's move over to the investment world and talk about SIPC, the Securities Investor Protection Corporation.
Right.
What does SIPC do for you?
So think of SIPC as the safety net for your brokerage accounts, similar in concept to the FDIC for banks. However, unlike the FDIC, which is a government agency, SIPC is a nonprofit membership corporation funded by member brokerage firms.
Okay.
And its core mission is to protect your securities and cash held at member brokerage firms if that firm fails financially and client assets go missing.
Okay, so what's the coverage limit with SIPC? Is it the same $250,000 we see with FDIC?
It's a little different. So the SIPC coverage limit is up to $500,000 in total value per customer.
Okay.
Within that $500,000, there's a specific limit of $250,000 for any cash held in your brokerage account.
Right.
This could be cash from selling stocks or funds you've deposited to invest.
Okay, so SIPC covers more than just the cash sitting in a brokerage account. What other investments are protected?
Yeah, it covers a range of securities that are typically held in a brokerage account. Yep. This includes things like common and preferred stocks, corporate and municipal bonds, U.S. Treasury securities, and importantly, certificates of deposit issued by a brokerage firm.
Okay.
Remember, bank-issued CDs are FDIC insured.
That's an important distinction.
It is.
All right.
SIPC also covers mutual funds and exchange-traded funds, or ETFs.
All right. This is a really important point.
Yeah.
SIPC does not protect you if your investments lose value because the market takes a dip or you make a bad investment, right?
That is exactly right. SIPC is not insurance against market risk or poor investment decisions.
Yeah.
It won't compensate you for losses in the value of your investments due to market fluctuations, or if a particular stock you bought performs poorly.
Right.
Its protection kicks in when the brokerage firm itself fails.
Okay.
And your assets are missing as a result of that failure.
So when does SIPC step in to actually help an investor? What kind of situation would trigger that protection?
So SIPC intervenes when a member brokerage firm encounters financial difficulties and can't meet its obligations to its clients in such a situation. SIPC works to recover any missing securities or cash.
Right.
And facilitate the transfer of your account to another solvent brokerage firm.
Got it.
The aim is to restore your assets to you up to the coverage limits and prevent you from losing your investments entirely due to the brokerage's failure.
Okay, now for our listeners out there who have, maybe more significant investments, that $500,000 SIPC limit might sound a little bit concerning. Is that something they should be overly worried about?
It's a valid consideration, but it's worth knowing that the need for SIPC protection is actually quite rare.
Okay.
Regulatory rules require brokerage firms to keep customer securities separate from their own business assets. This segregation is a critical safeguard.
Yeah.
And historically, instances where client assets have truly vanished due to brokerage failure are very uncommon. In fact, between 2014 and 2020, there were only 2 new SIPC cases where client assets weren't fully accounted for. So this rarity kind of underscores the effectiveness of the existing regulations.
That makes me feel a little bit better.
Yeah.
Okay, so just like with FDIC, are there any investments that SIPC does not cover?
Yes, there are certain exclusions under SIPC. These typically include things like commodities, futures contracts, foreign currency transactions, also known as Forex, and investment contracts and fixed annuity contracts that are not registered with the Securities and Exchange Commission, or SEC.
Okay, so we've gone through FDIC, we've gone through SIPC.
Yeah.
Let's bring it back to our main question. What's the core difference between the two, and why is it important for you, the listener?
So the fundamental difference boils down to what type of financial institution holds your money.
Right.
FDIC protects the cash you deposit in banks, while SIPC protects the securities you hold in brokerage accounts.
Got it.
Understanding this distinction is paramount because having the right insurance for the right type of account is what provides you with the appropriate financial safety net.
So the takeaway here is to make sure that all of your cash savings are in FDIC-insured bank accounts, and your investments are held in SIPC-insured brokerage accounts that way, no matter what happens.
Yeah.
You know, if a bank or a brokerage firm has some challenges,
Yeah.
you have that layer of protection.
Precisely. It's about aligning the protection with the type of financial institution
Yeah.
and the nature of the assets you're holding there.
Right.
And as we mentioned earlier, platforms like Wealthfront are interesting because they provide both SIPC insurance for investment accounts and that extended FDIC insurance for cash through their partner bank network.
Yeah. They've really found kind of a unique way to cover all the bases.
Yeah.
All right, so the bottom line here is that FDIC and SIPC are separate protections for different kinds of financial assets held at different types of institutions.
Right.
Knowing the difference empowers you to make informed choices about where you keep your money and your investments, giving you that crucial safety net and ultimately greater peace of mind.
Absolutely. This understanding allows you to be a more informed participant in the financial system and to protect your financial well-being proactively.
So now that you have a much clearer understanding of the distinct protections offered by FDIC and SIPC, take a moment to think about your own personal financial situation. How might this new knowledge influence where you choose to keep your cash
versus your investments? It's definitely a worthwhile question to ask yourself as you manage your financial future.
Absolutely.
And that brings us to the end of today's deep dive.
All right.
Until next time.
Looking forward to it.
Take care.
See ya.
Why?